And welcome everybody. Today is, what is today? June 24th. It's a Tuesday. So it is time for the $1 trillion show. This is where we aim to save Americans $1 trillion on their taxes. And you know, it's funny. So I was scrolling through Twitter the other day, X, whatever. And I came across this post that I see all the time. You see the different versions, you see it in different ways of characterizing, but it was talking about how the, you know, this percentage of taxpayers pay this percentage of the taxes, and it's not an even system and all this kind of stuff. That's like, that's true. But I made the comment that I always make is that it's like, you have to include payroll taxes. You can't just look at income taxes. And when you do that, it's hard to get that data actually, because what happens is the IRS will publish tables every year. So it's under the SOI, the Statistical Office, I think it's what it's. Anyway, they publish reports every year, and they'll break it out, say, you know, this percentage of taxpayers earning in this bracket for their AGI pay this much in tax, and they'll break it out line by line in a tax return. Whole lot of data on the individual side, less data on the corporate side, but that's all very easy to find. Data from the payroll tax side, very hard to find. So we know totals because the Social Security trustees, they issue a report every year saying how much taxes came in from you know, sources funding Social Security. And what I ended up doing the other day, this took me like an hour, is I was working with Grok in order to pull in the data from those reports and then try to calculate how much payroll tax is paid, because that's going to come in with FICA tax, which is, you know, from your W-2 employee. And I realize I'm getting like way into the weeds here already, but just bear with me for a second. So money going to Social Security comes from FICA, which is from W-2 income. Half gets paid by the employer, half gets paid by the employee, but the total is based on the wage the employee receives. And as far as a company goes, it doesn't matter how much is paid to the employee, how much is paid to Social Security. It's the total cost of employment to the employer that is the relevant number. And then people also pay in through self-employment tax. So if they have a Schedule C or self-employed Schedule F, or they have a 1065 partnership that carries self-employment consequences, all that gets into self-employment tax. And we know that the total for that for 2022 was $981 billion. And we know the totals for the wage breakouts from the IRS reports. So I talked to Grok and we had to go through some math, and it's not perfect, because what happens is that there's married filing joint couples. There's also a cap on Social Security taxes as far as how much wage gets paid. So it's complicated, but we can get pretty close. So I figured it's like, well, how much tax do people actually pay, right? So here's where we come up, and I'll make a post about this probably sometime this week. So this is AGI strata. So people who have an AGI, an adjusted gross income, under $50,000, there's 62 million returns that are in that category. So you can see the total is 153 million returns, 62 million of them, so like a huge percentage, are under 50,000 of AGI. And when you include income tax, which is almost nothing, but include payroll tax, they are paying 8.5% of all the payroll plus income tax. If you look at the next grouping, which is 50 to 100, it's another 28% of the people, and they pay 12.74% of the combined tax load. This is for 2022 numbers. From 100 to 200,000, that's another 20 million returns. They pay 23%. 200 to 500, only 9 million of those. They pay 22% or 21% tax, 21.74. And then you get to 500 to a million and a million plus. So very, very few people in these two groups, obviously, because most people don't make that much money. But they pay 10.6% of the total tax and 22.76% of the total tax. So this is a very different view on the tax load of people than you'll see most places, because everybody likes to leave out payroll taxes. but it's a huge component, right? There's the old, it's a meme at this point where, young person goes to work for the first time, they get the paycheck and they say, who took all my money? Well, it's, FICA took your money because, you're paying $293 billion worth of tax through your wages. So, in absolute numbers, obviously the highest earning people pay the most. The 500 to a million, surprisingly, is less total tax than the 200 to 500K. And it's less than the 100 to 200K. So it's these two groups really that are shouldering the biggest tax burden in aggregate. People making between 100 and 500. And that makes sense, actually, because we see people all the time in those two groups where, when we look at their tax situation, they have done nothing. It's like, well, if we do X, Y, and Z, and A and B and C, we can save you 30 grand, 50 grand, whatever it is. And that's what we aim to do, which brings me back to what we're doing now. So this is the $1 trillion show where I aim as founder of Tax Sherpa here. The goal is to have Americans pay $1 trillion less in taxes. Now, I'm willing to take that over several years rather than all in 1 year. But as we have seen over the last month or so, with all of the budget debates, there's still the big, beautiful bill, which is still being debated in Congress, even though they promised us a vote a couple weeks ago. Right now, the latest rumor or the latest version is no SALT cap adjustments. So that's a new development. But fixing spending is never going to work, fundamentally. The incentives of politicians in Congress is to spend more. And it's very, very easy to spend other people's money. I can spend your money all day long. That's no problem at all. So the only way to constrain the spending is to constrain the amount going into the government, and that's to reduce the tax load. So what I aim to do here through this show is share, strategies, techniques, tools with people so that people can reduce their tax burdens, very directly. And if we could reach all the people in that 100 to 500 range, most of whom, well, not most, but a lot of whom are small business owners, where you have the most control and the most leverage, then you can reduce your tax burden enormously and, reduce the spending of the federal government as a result. So that's what we're doing here. And I'm Neal. I'm the founder of Tax Sherpa. I'm the guy who used to owe the IRS $1.3 million. And that's how I got into the whole tax world through fixing my own problems. And here I am 15, 16 years later, after working off 50,000 tax returns and, bringing this expertise of like Wall Street style tax planning to the main street. And with me, we've got Serena and Fatma, two of our superstars behind the scenes. And, we're going to go through some questions that have come in over the last little while and see what we see. Because the answer to all tax questions is, Serena?
Memorable. It depends.
It depends. Now, it depends on facts and circumstances. What's true for you is not necessarily going to be true for the person next to you, because it depends on facts and circumstances. So, but we'll even though that's the answer to every question, we'll get into specifics and maybe what it depends on in these different situations. Every once in a while, we actually get a yes or no question.
That's true.
But yeah, so let's jump into it. What do we got going on this week?
All right. So for our first question, boss, this situation came up recently with a client, and we thought it was a great one to ask you. If someone has not filed taxes in 5 years, what is the first thing you look at to help them catch up safely?
Yeah. So first, you got to look at transcripts. So if you go to the IRS and you set up an account, you can download transcripts. If you don't have an account, you can have them mailed to you or faxed to you. So the faxing is fun because the IRS does not believe in e-faxing. They don't believe that system exists. And so you'll be on the phone with somebody and they'll say, okay, it's coming through right now. And you'll say, yes. And they'll say, okay, I'll send the next, it's crazy how technologically inept they are. But you get transcripts. There's different kinds of transcripts. What you'll want, first of all, is a wage and income transcript, because what happens after years is that people lose stuff. So I've lost stuff, my own tax things. And So you want to make sure you're not, when you do file something, you're not missing things, because that'll just trigger another round of letters and whatever. So you want to avoid all that. Also, what happens after 3, 4, sometimes 5 years is the IRS will file what is called a substitute for return, SFR. And so they'll take whatever information they have on file from third-party sources like 1099s or W-2s or whatever, and they'll create like a composite tax return based on the worst possible set of assumptions. And if you owe money at the end of that process, you'll get a letter. That's how my tax problem started, because I hadn't filed for several years, put some stuff together, and they say, hey, you owe $1.3 million. And if you would have gotten a refund under whatever assumptions they built, then you'll never hear from them, because they do it after the statute of limitations. So there's different statutes of limitation. The relevant one here is the 3 years to claim a refund. So we are in 2025 right now. The filing due date for 2025 is going to be April 15th, 2026. And I have not checked if that's on the weekends, because if it's the weekend, we'll go to the next month. But normally April 15th, right? And so the statute of limitation for getting a refund from tax year 2025 is going to be 3 years past the April 15th, 2026 due date. So April 15th, 2029. If you file a 2025 return in 2030, you are past that due date. And even if you were due a refund, you'll get a letter from the IRS saying, oh, you were due a refund, but so sorry, you waited too long. Tough luck. So, it's funny how they do these SFRs after that has expired. Anyway, so at 5 years, you might have tripped into that process. It kind of depends on their workload. So that's the thing to check first, because if they have filed a substitute for return, you have to file, when you file your return, you got to put some language at the top of the tax return saying, hey, filed in lieu of, whatever. There's a citation you put in there. So, so that's number one. Check transcripts, see if an SFR has been done, and see what's on the wage and income transcripts to see what we're dealing with, because a lot of people just lose stuff, like I said. And then it's, you file a return as best as you are able from that information. One of the things that's changed with transcripts over the years is that before like 2019 or somewhere around there, the full information was available as far as the headers, as far as like who paid what and what their EIN was. And now you can still get that, but you have to go through a special process. The regular transcripts are truncated, so we only show like the first 4 or 6 characters. I think it's 4 characters. And so if you know what those things were, you can usually figure it out. If you don't, that can be tough. But yeah, that's step one whenever we're dealing with old returns like that.
Alrighty. So it looked like we have another question that came in. Someone wants to know, if you were starting a brand new business today, making $100K, what would be your very first tax bill that you'll make?
I would just go through the regular process that we go. So step one is entity optimization. So figure out, should I be an LLC? Should I be a corp? Should I be an S corp? Should I be a C corp? All these different things. Sometimes it should be partnership. Sometimes it should be this. Sometimes it should be that. And that's always the first step. And then we look at deduction strategies, and then we look at optimization for salary and retirement and all this kind of stuff. Because tax-free is better than taxed, and tax advantaged is better than full tax. So there's an order to that. And first step is entity selection. So yeah, that would be step number one. That's an actual not independence question.
And that was very fast. You answered that very fast.
Yeah, well, that's the process.
Mhm.
Yeah. So for my next question, boss, this came up from someone using TurboTax. So what's one audit red flag people don't realize they are triggering just by using it wrong?
Well, yeah. So TurboTax itself is not the problem, because if I use TurboTax, it would come out the same as how I use any other piece of software, right? It's operator error, and it comes down to the fact that people who use TurboTax don't know what they're doing, which is why they're not professional tax people. Anyway, so the biggest red flag that you can do is, well, I mean, there's a bunch that might tie for first, but the biggest number one is having large losses on a Schedule C, especially with no revenue. So that's audit flag numero uno. Schedule C is the, well, so the number one biggest audit flag is to use the federal fuel tax credit, which is an illegitimate thing for the vast majority of people who claim it. And the IRS has actually cottoned on to this fairly well over the last couple of years. Finally. And, but that's something that shady taxpayers do. That's not something that your average TurboTax user will do. What people at TurboTax might do is they will file a Schedule C, which is a disregarded entity or unincorporated business. That's just under their personal name, and they'll have all these expenses, and they'll have no income. So part of having expenses that are deductible is you have to be in service. You have to be actively having a trader business, and it's not guaranteed that you're going to have some sales, but you probably will. So if you spend $20,000, $50,000 on some business activity and you have zero revenue to show for it, are you in business? That's a very valid question. And in some cases, it could be, right? So the example I always give is this place that opened up near me. So I go to the shopping center where the grocery store is around the corner from my house. And in the corner of the shopping center is, a bay that had been turned over several times actually. But one time I went there and there was this serve your own popcorn place. So they had all these different flavors of popcorn. You pour your own and then they weigh it and then you pay by weight. At least I think that's how it worked. It was like those frozen yogurt places, but for popcorn. And I have never seen this store concept before for popcorn. I've not seen one since. So I go there. They have their sign saying grand opening. They got the big machines. They were like big gumball style machines filled with popcorn. They were shiny. They looked good through the window. But I don't really eat popcorn. I didn't go in. I never saw anybody else go in. The times that I was going to the grocery store. And so 3 months later, they were gone. Now, it is theoretically possible that they had zero sales and they were in business. They were trying to make sales. They had all the operations, they were open to the public and all this kind of stuff. But realistically, they probably had some sales, just not enough to keep going. Right. So, while it is technically possible to have no revenue, and be open for business and trying to make profit, it's unlikely that you have literally zero. Usually at least somebody trips and falls and comes into your place and gives you sales. So that's the biggest red flag when it comes to audit for people who are preparing their own stuff on TurboTax or whatever other software they'll be using.
Alrighty. So it looks like you have another question that just came in, Neal. Someone wants to know, what's your favorite low-key way to pull money out of a business without getting killed in taxes?
Oh, my number one way is through accountable. So accountable plan is under Section 162. And this is a reimbursement plan for money that you're already spending that has business purposes. And basically, if you ever worked for a place where, you went on a trip or something and you had to send in your receipts, then that's an account. It's like, hey, I spent money for business purposes. The company reimbursed me. As reimbursement, it's not taxable at all. So, there's ways to, if you have the right business setup, the right documentation in place, there's ways to, lever some of those things that you were paying for already into the business. So that's my favorite number one. And there's other ways, but that's definitely the place to start.
Yeah. Yeah. So for my next question, boss, a lot of people with side gigs ask us this. What's your rule of thumb for when someone needs to turn their side hustle into a business entity?
Yeah, I mean, it depends on the scope, really. It's like, how much activity are you spending on this, and how much time and effort and money are you putting into this thing? And so, I mean, if it's something you do like once a month and you make $5,000, then okay, you probably leave that as a disregarded entity. But if you are putting serious effort and time and money into this thing, then that's typically going to be, we want to organize it into a separate entity. Yeah, it's not a hard and fast rule. I I've talked to many clients over the years, and a lot of times, we talk about S corporations, and I'll see on X, there's all these tax people on there that I come across, and they're like, oh, people are overusing S corps and whatever, and every accountant, every tax preparer in the world has a different opinion about this. And I've heard people say, oh, you need to be making $200,000 before it's worth it to do an S corporation. It's like, what are you talking about?
Right.
I've heard people say 100,000, 50,000, 20,000, zero. There's no rhyme or reason. If we're talking about S corp specifically, then there are potential things you got to deal with. So if you're profitable, then you have to think about salary. If you're not profitable, then you don't. Either way, if you're organizing into a separate entity for tax purposes, then you're either going to be a C corp or partnership or S corp. Each one of those is going to have its own filing, which is typically a good thing from an audit perspective, just to split it off into somewhere else. So it depends on the level of activity. It depends on what the goal is with this whole thing. Some people are very high earning W-2 people. And for them, it's worth just splitting it out from day one, simply because of audit risk, right? Even though the numbers are the same, it's just that the fact that you have higher income, you have higher audit risk already. So you don't want to double down on that by creating like Schedule C or a Schedule F that has its own elevated audit risk. So by putting it off into a 1065 or 1120S or some other filing, then that helps reduce the audits. So yeah, it depends.
Definitely it depends question.
Yeah.
So it looks like we have someone that just wrote in, Neal. They're asking about the leverage giving. They said, you mentioned leverage giving before. Can you break it down in regular terms for someone who's never heard about it?
Yeah. So leverage giving is an interesting one, where there are people who have put money into foundations in the past, and they did that for their own tax purposes. So whenever you hear these celebrities or billionaire types talk about stuff, oh, we gave this $10 million to charity. It's like, well, did you? This usually it's their own foundation. And then, they get a charitable contribution from that, and, they can reduce their tax load, right? There are a lot of rules to go along with it. One of the rules is that the foundation has to give away a certain percentage of its assets every year. And so leverage giving is a strategy that has been developed by some of these guys who basically they give you a loan in order to contribute. So they send the money to you, and you send the money to a different charity, and you get a large charitable deduction for it. And you prepay some interest, so they make some fees and all that kind of stuff. But it come on dollars ahead, simply because of the leverage involved. And, it does incur, a liability at the end, which could be, 20 years, 50 years, it's written up. But that's the basics. You're effectively borrowing to give to charity, and there's a back end that you have to deal with farther down the line. Sometimes, upon death, which at that point doesn't matter. But yeah, that's the basics. I mean, it is obviously more complicated than that, but that's the basic mechanics. And so,
Win-win deal, you're saying?
Yeah. So, this is under one of what I call the exotics. And, it's a win-win if you're in a high tax bracket. So typically what happens is all of these exotic strategies, they all carry fees or interest or something, there's some money that you're paying. And so, people selling film tax credits or renewable energy stuff, or, there's a book. But the numbers always kind of come out the same. It's like, okay, if I'm a high tax bracket, I'm paying 35 or 37% federal plus another, whatever, 5%, 10%, or 13% if you're in California. So I might be paying anywhere from 40 to 53, but 40 to 50%, let's say, on my high bracket income. I'm going to turn around and go into one of these other strategies, and I'm going to pay 20-ish% to those guys in order to get the tax break. And it's like, okay, that math works. I'm giving away 20 to get 40 back. So my net positive is 20. So it's a win-win in that sense. But you do got to come up with the 20% typically. And so, the charitable strategies is one of those where, that's kind of how the numbers typically work out. So if you're in those high brackets, then
Yeah. So for my next question, boss, so we had a client get nervous about IRS letters. So he wanted to ask, what is this scariest IRS letter that's actually not a big deal and the quietest one that's a real problem?
It's a good question. So the one that people, freak out about is corporate late filing penalties. So, people have tax due dates, April 15th. Corporations have tax due dates. If it's a pass through, it's a month before the individual due dates. So, March 15th, regular. If you do 6-month extension, it's September 15th. And that's a month before the individual and C corporation deadlines of April 15th, and extension goes to October 15th. So it's a month before, because you need those documents in order to complete your individual tax return. So what happens a lot of times is the IRS has their classifications all screwed up. So there have been times when, like, let's say there's an S corporation. We filed as an S corporation last year, accepted, no problem. Files it as an S corporation again, accepted, no problem. The third time, files an S corporation, rejected. This is the wrong type of corporation. That's like the error message from the IRS. And we're like, the hell are you talking about? We didn't change anything. You've been accepting it. And so then you file it, manually. And then by the time they process it, it's late and they send out this letter. So the letter, one of the forms, there's a couple different versions of the letter. One of them says notice of intent to levy. And they'll just say like, $1,200 or something like that. Depends on how many people and how many months and all this stuff. And people freak out about that because they think, oh no, the IRS is going to take my house. Well, don't freak out. Number one, it's not to you, it's to this corporation. It's a different tax entity. That's kind of the whole point. So, if that entity has a bank account with millions of dollars in it, then okay, that might be a concern. Obviously, if something were that kind of issue that had to be paid, then just pay it, right? But it's not you that aren't going to take your house or anything like that. The one exception to that is, well, this isn't a late filing penalty, but if you mess with your trust accounts with payroll, they don't like that. They will come after you personally. But for just late filing of tax returns and stuff, it's just to the company. And as long as you didn't break the company by piercing the corporate veil and doing things you're not supposed to do, then you're fine. And then typically we can almost always get rid of those penalties anyways, because it's either their screw up with this, like electronic matching system that they have, or just one of the things that we do here at Tech Sherpa is to preemptively file extensions. So we will try to file electronically first. A lot of times those don't work, and we will file by mail under multiple code types just to make sure that it gets through the system. And but anytime we mail something to the IRS, a lot of times they lose stuff. It doesn't get recorded correctly. It's a madhouse over there. But keep our receipts and all this kind of stuff. It says, well, you accepted it on this date with this tracking number, and it eventually goes home. That's the vast majority of the time. So that's one that people freak out about and shouldn't. And one that they don't freak out about and should is, well, so what happens is, I don't know if it's don't freak out and should, but don't do anything and should. So 70% of the letters that the IRS send get no response at all. And people just, throw up their hands or put their head in the sand, or whatever analogy you want to use. and they just take it, right? And the vast majority of those cases are low income people who get challenged on earned income credits and child tax credits. So there's two different forms that those take. So, the earned income credit and the child tax credit are money that are given to taxpayers who have earned income of various kinds. Could be self-employment, could be, W-2, and have children in the appropriate ranges. So they got to be, like for child tax credit, it's birth through 16. For earned income credit, it's birth through 17, but it can go longer if they're in school. And, the IRS pushes back a lot on these credits because they are the largest outflows from the IRS. And so, many years ago, probably like 8 years ago at this point, the congressional committee hauled the IRS commissioner in front of them and said, "Hey, why are you auditing these people? These are poor people. Why don't you go after rich people?" And the IRS commissioner at the time, he said, "Well, basically it's easier." It's kind of the summation of what his testimony was. And we went on to explain that, well, rich people, one, they have, professional help that, are very good at rebutting audits. Two, on the IRS side, it requires a higher level of expertise. And it's harder to keep that employee at the IRS because they know they can go out into private industry and make more money. And you'll see a lot of guys on, LinkedIn or whatever, and he'll say, former IRS auditor, whatever. And that gives them that cachet of, it's like, well, I was on the inside, now I'm on your side, right? So I know this and that, which is sometimes true. As people develop those expertise, they then leave the IRS and they're harder to keep on staff. They're more expensive to train, more expensive to keep, and all this kind of stuff. And so as a result, they audit poorer people who get these tax credits. And, those IRS employees are easier to train because it's a lower level of sophistication. And the people who receive those letters don't fight back fundamentally. So those people should fight back, because again, there's two different challenges that the IRS comes up with when it comes to challenging these tax credits. So number one is, are these your children? I had one client many years ago who, we sent in all kinds of proof, like birth certificates, whatever, and they just deny. And so he actually ended up going into the local field office with his children and said, "These are my children."
That's funny.
And, finally they dropped it basically. So, if you weren't necessarily married when you had a child and somebody has a different name, then say, okay, maybe there's some questionability there, but, typically you got to prove that they're related to you. That's going to be generally through a birth certificate, and you got to prove that they live with you. And that's going to be through like a lease or a utility bill or school records or something listing your address and their name. And then that's going to match your tax return with your name and your address. So that's typically how you prove that it's your qualifying child. Right? So that's the first avenue of attack. The second avenue of attack is like, did you have the earned income in order to justify this thing? And this happens a lot with self-employed people. So if you don't keep good records and you make cash, let's say you're a cleaner, you're a house cleaner, and you have your customers and you make $30,000, and have cash, a check, and have somebody deposits to Zelle or something like that. You can have a lot of trouble proving that you have that income that justifies you in order to take the tax credit. And so, it comes down to record keeping. The vast majority of what IRS gets people on in audits is record keeping, because people don't keep records or don't keep good records. And so, that's far and away the number one cause of people losing those kind of challenges from the IRS. But yeah, so those people who get those letters, don't freak out enough, because we know that they're not responding. So yeah, I mean, if you're entitled to that tax credit, you should absolutely claim it and keep it and defend it. So that's number two. This is actually one of the things that's in the bill right now for Congress. So Section 179 is to allow for complete, or not necessarily complete, but faster write-off than normal depreciation. So you buy a business asset, like let's say, furniture. Furniture, depending on the type and whether it's office or whatever, can be like a 5 or a 7 year depreciation schedule. Now, bonus depreciation is a separate beast. Well, come back to that in a second. But let's say you buy some office furniture. It's a whole suite of stuff. It's $7,000. Now, normally, under normal depreciation rules, you would get $1,000 a year of write-off for that $7,000 purchase, because that's considered the useful lifetime of that asset. So it's more than 1 year, so you got to write it off, matching that useful lifetime. And so you say, it's like, well, I have income, and I'd rather write it off sooner than that. So then you use Section 179, and you can write off, the full amount or up to the amount of profit you have, whichever of those is less. So if it's a $7,000 thing, and I make, net profit after everything, I make $100,000, then I can take that $7,000 deduction. That's going to reduce me down to 93. Okay, so that's scenario number one. Scenario number two is I've got $5,000 of net profit after everything is said and done, because just that's the kind of year it was, and so I can only deduct $5,000 of that $7,000 under Section 179, and the rest will roll over. And you can potentially do 179 later on the remainder, but depends on that later. So that's how Section 179 works. There are limits, and there are special rules for certain kinds of assets and all that kind of stuff. But that's the general idea. So bonus depreciation is better typically, because bonus depreciation does not have the limitation of profitability. So if I have $5,000 of net profit and I've got the $7,000 asset, if I'm able to take bonus depreciation of 100%, then I could go from 5 to -2, which is in most cases better than just going to 0. But the rules for bonus depreciation come and go. So 2011, we got unlimited bonus depreciation, and that was great. And then 2017 rolls around, we get Tax Cut and Jobs Act that brought back 100% bonus depreciation. But then it's starting to expire, and it's in its wind down phase right now, because of everything from Tax Cut and Jobs Act is expiring. So that's part of the big beautiful bill that's in Congress right now. They are wanting to bring back 100% bonus depreciation for the regular stuff, like fixtures and furniture and equipment and that kind of stuff, and making it permanent rather than just having this expiration period. And they want to create 100% bonus depreciation for factory construction, which, if you're in the manufacturing space, is huge. Because, if you were to build a factory, typically that's a 39-year period. That's a non-commercial real estate. And if you can write off building the factory in the year that you build it, then that is an enormous incentive that you could take advantage of. So just, different things to be aware of as the rules change constantly. So so that's a little bit about 179 versus bonus. And they are talking about adjusting the rules for the 179 as far as dollar limits and things with the big beautiful bill as well, but it's just not as relevant when you get bonus depreciation. So and in certain circumstances, you can actually do both 179 and bonus, but that's fairly rare. All right, so that's all my it depends for 139.
Understood. Well, Neal, we have a pop quiz round for you. Right?
Quiz, all right.
So, are you ready for it?
I'm ready.
Okay. So, what is the primary purpose of a 1031 exchange? Is it A, to eliminate property taxes, B, to defer capital gain taxes on real estate sales, C, to reduce mortgage interest rates, D, to avoid income taxes on rental income, or E, none of the above? So which one?
It's a little bit B, but a little bit E. So, so 1031 exchange is when you have investment real estate. It's not all real estate. It's investment real estate. And you decide that, hey, I'm going to keep this asset, or I'm going to keep this money in the same asset class. I'm going to keep it in real estate. Now, before Tax Cut and Jobs Act, it was more general. But then Tax Cut Jobs Act changed 1031 to be real estate only and investment real estate only. And no, not too surprising, Trump was a real estate guy. So, it's a like kind exchange. So as long as you exchange one business asset for another business asset of a like kind, then as long as, to the degree that you don't take any money home, then that transfer is tax deferred. It's not tax free, but it's tax deferred. So, if you're a real estate person, investor, whatever, then, you have, asset A that let's just call a single family house. It appreciates, you sell it. You say, okay, I've got $1 million of capital gains. It's in a nice neighborhood, whatever. And I don't want to pay taxes on it. I still want to stay in real estate. So I'm going to roll all that money, all the proceeds into another purchase. And typically the way this works is you go up in size of the deal. So if I start off with $1 million deal, I'll put that as a down payment and I'll finance the rest. And now I'm into a $3 million deal or a $4 million. Maybe it's a small apartment house or something. And then, time goes by, you decide to sell that one. And then you say, well, do I want to take the tax hit now or do I want to roll it again? And you could go whichever way you want on that. But typically what happens is that people who start doing 1031 exchanges have to continue it. They have to, because what happens is the cost basis of your original purpose is your original purchase is what gets moved forward into the next asset. So let's say, we had that $1 million sale. Let's say I bought it for $500,000. Right? So now I've got $500,000 cost basis and I roll that money into a $4 million apartment house. Right. But now my cost for tax purposes is still $500,000. So now if I sell that $4 million thing, I've got a much bigger spread that I have to pay taxes on. And maybe I don't have the cash for that because I refinanced and I took the equity out and did all these things. And so, the danger with 1031s is that you can get tracked into continuing them. If they work great, if the plan is to follow the buy, borrow, die strategy, you buy the assets, you borrow against them, and you keep them rolling, whether you keep the same asset or you do 1031s into other assets, and you keep it going until you die. And then your heirs get a step up in basis, and it becomes a tax-free transfer across the generations. So, that works great with 1031s. If 30 years goes by and you say, well, it's time to sell, my kids, I hate them, it's whatever, right? Then you end up with enormous tax bills at that point, because the thing you bought 30 years ago, not only was it a smaller deal, but, inflation has eroded that value away anyways. So, if you think about 30 years ago in 1995, what were real estate prices? It's like, a fraction of what they are today. Even if you were buying, at the market then, that you didn't get a special deal or whatever, that's how inflation works. So, I remember, talking to a friend of mine. So in 1995, I was 15 years old. And I remember talking to a buddy of mine and, we were talking about our houses, and really we knew nothing about our parents' financial situations. But we were making, wild guesses. and he had said that his dad had told him that it was stupid not to have a mortgage at that particular current time with those particular, rates and things. It's a debatable position you could take. But whatever the case is, even if you financed 100% of that house 30 years ago, it was 150 grand. And now that same house is 600 grand, right? So, is that, when you look over these longer time frames with these 1031 implications, the tax bill just grows, because now we're looking at, 600,000 against 150, even though it's the same property, that it was 30 years ago. Yeah. So it's just a thing you got to deal with if you enter that game. So I would say the answer is B, but you got to restrict it to investment real estate and the capabilities associated with that. So,
Good answer. Thank you.
All righty,
what
boss.
else do we have in the quiz?
Yeah, so here comes your second pop quiz question. And what is the benefit of using a health savings account? A, it provides tax-free income. B, it allows for tax-deductible contributions and tax-free withdrawals for medical expenses. C, it eliminates the need for health insurance. D, it reduces payroll taxes. What's
Yes,
your
B.
pick?
So an HSA cannot be used in place of health insurance because it's required to be attached to a high deductible health insurance plan. So yeah, you can contribute to an HSA, and some people do it for company benefits and they don't see the money in the first place. Other people take the money and then contribute and take a tax deduction that way. So there's different ways to set that up. But yeah, you can put money in and it becomes a it's either a tax deduction on your personal taxes, or it is never comes into your wages in the first place. So it's a deduction before you see it. And, that money can grow potentially, depends on your HSA administrator and what your options are. And then if you use that money for health purposes, then you can withdraw that money tax-free. So that's helpful. If you don't use the money for health purposes, at retirement time, it converts into effectively an IRA. And so you can take the money and just pay regular income tax on it at that point. So you got a deferral, putting the money in, and then you pay regular rates, ordinary rates coming out. So in that scenario, it functions as a traditional IRA. If you pull the money out before you retire or before retirement age, 57 and a half, and you don't use it for health expenses, then you will pay income tax and you'll pay penalty on it. So, but most people have enough health expenses that's just fine. But very few people that I've seen are actually able to accumulate any significant amounts of money in their HSA simply because health expenses are so expensive and everybody has them, periodically. So, yeah, is the answer.
Are you ready for another pop quiz?
These questions we got.
So we have 5 minutes. So this should be short. But the question is, what is the main advantage of a 401k retirement plan? Is it A, it provides tax-free income? B, it allows for tax-deferred growth on contributions? C, it eliminates payroll taxes? Or D, it reduces property taxes?
So property taxes has nothing to do with it. Payroll taxes, no. So you do pay payroll tax on the amount that you put into a 401k. A lot of people forget about that. So all these are B. I don't know why. So yeah, and the answer really, whether it's tax deferred or not, is going to depend on if it's a traditional 401k or Roth 401k. So traditional 401k, you put money in today, you get a tax deduction today, and then the money grows, hopefully. And when you pull the money out, you're going to pay taxes at that future date. So what you're speculating on is that the amount of benefit I'm getting today, if I discount that cash flow into the future, it's going to be less than the amount of taxes I have to pay when I bring that money back home. In a Roth 401k or a Roth IRA, same kind of deal. I pay taxes today, so there is no taxable advantage today, but I put that money in and then it grows, hopefully. And when I pull the money out, it is tax-free. Assuming that you wait till retirement and blah, blah, blah. So yeah, B, unless it's a Roth, in which case it's no deduction today, but benefit tomorrow. So that is the answer. All B's. Before we go,
say one thing,
yeah,
really fast. You passed with flying colors.
Awesome. I wasn't worried, but okay. All right. Before we go, I do want to share, I've shown this a couple times before, but the tax strategy self-check. So if you want a copy of this, just email us, office@taxsherpa.com. We'll send you a copy. It's a very straightforward checklist, and you just go through. For each one of the first two categories, you get a +1. For the third category, you get a -1. The point of this is to help people figure out what it is that they're actually doing. Because a lot of people think they're doing tax planning and strategy and all this kind of stuff, and they're not. So this kind of guides you through a couple of different scenarios, and you can score yourself and figure out if you're getting actual tax planning, or if you're just getting what we call in the business tax compliance. Now, the compliance is the filing of the forms. That does have to be done. And it needs to be done accurately and all that kind of stuff. But, most people, what they actually want is tax planning. They just don't know it's called that. So you got to find people who actually do that rather than just generic compliance work. So if you're interested, just email us. We'll send you a copy. Someday, at some point, I will set up a little landing page where you can just get it and you don't have to email us. But I haven't done that yet. I'm actually giving a talk tomorrow on this self-check checklist there. So if that's of interest to you, let me know or let us know. And Fatma here will send you a copy. With that, we are coming up on the end here. And let's see. Next week is what? Next week is the 1st, July 1st. Okay. I thought it might be the 4th of July, but it's not. So we will be here next Tuesday and we'll do it all again. And maybe there will be another pop quiz. I don't know. This is a complete surprise to me. So we'll see how it goes. Anyway, everybody out there, I hope you take some of this knowledge and realize that even if the particular thing doesn't apply to your particular situation, you can start to think about your own situation and realize that there are all these questions to figure out. And whether you want to talk to us, you can go to taxsherpa.com, click there, or if you want to talk to somebody else, that's fine too. We're certainly not going to be able to handle everybody's tax situation, even though I wish we could. Point is to reduce your overall tax liability and, reduce the amount that's going into government in taxes. So they have less of our money to spend. All right. With that, we'll call it here and we'll see you next week.
All right.
Have a good one.
Bye.
Have a good